Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, August 7th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, or to get on the right side of market risk to the extent you haven't been following Kiss and Dr. Mo, you need to be a client of 42 Macro. So today's key macro questions are, how will POTUS reshape the Fed? And how should investors gauge the impact of tariffs? Our answers: President Trump signaled he will nominate a temporary Federal Reserve governor over the next 2 to 3 days to fill the upcoming vacancy, but he will save the announcement of Jerome Powell's replacement as Fed chair for later, maintaining flexibility in reshaping the central bank's leadership. Trump's deliberations come amid three Federal Reserve officials, San Francisco Fed President Mary Daly, Minneapolis Fed President Neil Kashkari, and Fed Governor Lisa Cook, flagging softness in the U.S. labor market, keeping September rate expectations alive. Where were these people last week? We had, hey, Lisa and Neil and Mary, we had an FOMC last week in which you could have voiced these opinions. I digress. These two late pivots come amid the Bank of England cutting its policy rate by 25 basis points to 4%, the lowest in over 2 years, in a 5-4 split that required 2 rounds of MPC voting for the first time in its 28-year history. The rate cut came amid the MPC revising its 2025 headline CPI forecast to 4%, up from 3.7%. All told, the Bank of England represents a model of a central bank that understands the world is living through a high sovereign indebtedness requires high nominal growth regime. The world is also undergoing a major geopolitical restructuring with respect to trade and military readiness, which tends to occur during forward turnings. And this dynamic also adds to underlying inflation pressure. Given these preconditions, it would be foolish for any central bank to stubbornly stick to an arbitrary 2% inflation target and stymie growth throughout the entire process. We can only hope the administration and the Fed are paying attention to our thought leadership on this subject matter. We all know we have a very famous person in the administration who used to be a former client. So if you're listening, Scott, please provide this up the flagpole so we can boom this economy. Elsewhere, President Trump's reciprocal tariff regime took effect at midnight. He also signaled a 100% tariff rate on semiconductors planned while pledging exemptions for Apple and other manufacturers who ship manufacturing to the U.S. after a visit to the Oval Office by Apple CEO Tim Cook. You should know by now how POTUS operates. Kiss the ring, get the green. Our friends over at the Yale Budget Lab estimate the average effective tariff rate is now 18.3%, which is the highest since 1934. After accounting for substitution effects, the average tariff rate will be 17.3%, the highest since 1935. The Yale Budget Lab further estimates Trump's tariffs will bring in $2.7 trillion in revenue in the 10-year budget window ending in 2035. Their estimate declines to $2.2 trillion after accounting for dynamic scoring. Our friends in the Penn Wharton budget model currently project tariff revenue over the same time horizon at 3% and 2.6% trillion, or sorry, 3 trillion and 2.6 trillion on a raw and dynamic scoring basis, respectively. These figures imply durability to the new tariff regime beyond the current administration. It's going to be very hard for the next president, whether they be Republican or Democrat, to turn off these revenues in the context of our, persistent structural 6 to 7%, budget deficits in terms of budget deficit to GDP ratio. So, we're in a new world order here as of midnight last night. And so investors just need to accept that and move on. And I think the markets largely have, in the context of being forced to capitulate into our paradigm C view, which is exactly what we've been telling you it would do since May 3rd. We set the market, so you're going to see a wave of upside capitulation as one by one, fund A, fund B, strategist A, strategist B, analyst A, analyst C, B, C, D, E, F, G. They're all going to be forced to realize that it's not just about tariffs. It's about trying to outgrow the deficit and the debt. Now, we're not going to be successful at this, but it could take years before the plan fails, before paradigm C fails. And so ultimately, a lot of what we're seeing in asset markets in terms of responding to the various levers that the administration is pulling to engineer to make our paradigm C thing come to life. That's exactly what we continue to see. And then ultimately, one further lever that we're likely to see as we move forward in time on a long-term time horizon, which is 12 plus months in our risk management nomenclature, is regime change at the Fed. It's coming, whether you position for it or not. If you want to blindly sort of, keep this very narrow distribution of probable economic and policy outcomes in your brain in the middle before turning, be my guest, you're going to be the ones buying the Bitcoin and gold years after we've already made a ton of money on it, and the stocks years after we made a ton of money on it, much like folks have already are doing currently. So, I think we got this right here. I think we got quite a long time to let our Paradigm C theme play out, and we have among the best cost bases on Paradigm C of any investors in the world, and we're super proud of that. Really grateful for all of our partners, of our clients for partnering with us on this journey. So, speaking of transitioning to our 42 macro dashboard, as always, a wrap up with the question from our community. I thought this was a phenomenal question here. Question about trust. So it reads, this is my second month at 42 macro. I admit too many years of BS advice has left me a bit or more broken on stock markets. I realize I cannot just have my money in treasuries and have a comfortable retirement, even though my financial planner says I can. My simple question is, how do I get to the point where I can trust the KISS system? I really just want to set it and forget it until KISS tells me to change. My paranoia is that Dr. Mo is telling us to go along right before top. I realize that dollar cost averaging may help with this, but in that case, it would only reduce the losses versus going 100% all in one day. I'd be interested in hearing how other users have been able to get to a point of trust. Please don't think I'm hating on 42 macro. It's really just years of broken advice from other advisors that have me questioning everything. So love this question. The reason we built this company is because of broken BS advice that you guys, the retail audience, has been getting from Wall Street for decades. The reason we have a large and thriving business after only being in business for less than a half decade is because there's so many people like this that have been turned off by the horrifically bad solutions Wall Street has concocted to sell to retail investors. How many people do you think work at Citadel, BlackRock, Point72, and Millennium have their money in a pie chart asset allocation? Zero. How many of them do you think have their money in a target date fund? Zero. The solutions that Wall Street sells to itself and its clients are very different than the retirement solutions that they sell to you, the retail audience. And when they want you to be active, they're giving you stock picks and this latest tip and that latest tip. They're not giving you institutional grade risk management that allows you to stay on the right side of market risk throughout your investing journey, which is what they're doing, that's what I get paid by them to help them do. And so I can understand the frustration of this person after it seems like decades of, having poor results based on not great products that they've been marketed to by, Wall Street. And so 42 macro exists for this very reason, which is to take the best from the perspective of the best practices that I've observed that we've built into our process here at 42 macro across global Wall Street. What are the best practices in terms of analyzing data? What are the best practices in terms of risk managing markets? What are the best practices in terms of constructing portfolios and asset allocations and portfolio constructions? This is almost 17 years of learning from some of the best and brightest people in the world do their jobs for their clients effectively, and collaborating with them and consulting with them, learning from them, teaching them. It's a collaborative ecosystem when you're inside those rooms. 42 macro exists is to open up the door to those rooms and all those buildings that I've been in around the world and bring the retail audience into the room, give you guys a seat to what's happening on global Wall Street, and ultimately give your portfolio exposure to the types of solutions that we create for ourselves that have historically been unavailable to the retail audience. And so in terms of building confidence in KISS, the reason I tweet out our testimonials page all the time. And the reason I do that, obviously it helps us grow our business, but that's not why I tweet it out. The reason I tweet it out is because I want other investors to realize that other investors around the world are waking up and saying, oh my God, this is exactly what I've been looking for. Oh my God, I've never had better returns. Oh my God, I've never slept more soundly at night. So there's hundreds of testimonials from our clients. From again, we have clients in 80 countries and all around the world, thousands of clients all around the world that are all saying some version of the same thing, which is thank God for 42 macro, thank God for KISS, thank God for opening my eyes to institutional grade macro risk management, because it is very different than what I've been dealing with previously. And especially if you're at or near retirement or even in retirement, you can trust KISS because these testimonials are coming from people around your age. Our client base skews pretty old, which by the definition, it almost has to. That's where all the money is. If you look at the split between the share of, as a matter of fact, let me pull up this chart. I think I have this chart right in front of me. Sorry, I'm gonna try to find this chart. I want to be specific with these. Yeah, here it is. So if you're over 40 years old, in terms of U.S. household wealth, the over 40-year-old cohort owns 91% of the wealth in America versus 9% for the below 40 cohort. So by definition, the people who are investing in financial markets generally skew, older in age. And so obviously that's where the investors are. And so you can trust this system. I'm not saying KISS is suitable for you. Go find that. Go talk to your financial advisor. They'll tell you if it's suitable for you or not. What I'm telling you is it works. And it keeps you on the right side of market risk, and it eliminates big drawdowns in your portfolio. So no matter what your financial advisor says about this, if they don't have a response to these returns are better than the pie chart that they're selling you, the drawdown and volatility characteristics are way better than the pie charts they're selling you, and ultimately the process is more robust than the pie charts they're selling you. So I can see why they would tell you that it's a bad idea, but I'm telling you, these people that I'm scrolling on the screen are telling you it's a phenomenal idea. And so don't take my word for it. Just go to our 42macro.com/testimonials and start reading. And if you get to the bottom of these hundreds of testimonials and by then you still don't have confidence in the system, then God help you. God help you. One final thing I will say is I think there's a misnomer here in this question. KISS and Dr. Mo are never going to tell you to do different or opposite things. They move in the same direction. Dr. Mo is different because it's a on-off switch across 70 factors for institutional investors. It's really not an on-off switch. It's a half on, half off, or on, half on, off switch for 70 different factors, institutional investors. And KISS is sort of a dial for 3 different factors, or sort of 4, if you include cash. KISS is a dial between cash, stocks, gold, and Bitcoin. And so you can, you have a little bit more flexibility in KISS in terms of how that process works, but it uses the exact same top-down and bottom-up risk management overlays in terms of incorporating volatility targeting and dynamic position sizing into both strategies. So I hope everyone's aware of that. And I'll stop ranting and let you guys go about your merry way. Everyone have a fantastic day. Catch you back here tomorrow. Cheers.